So, our first discussion this week is about financial statements, tools, and budgets. With respect to financial planning, your textbook talks about spending, saving, and risk, but I like to actually extend that into a short term and long term financial planning as well. So, with respect to spending, obviously, these are your expenses and these include every sort of expense that you incur in your life. So it could be simple things as eating, groceries, your rent, transportation, insurance, your textbooks, your leisurely spending, any sort of spending that you have to do or you do by choice falls into this category. It is important that we optimize our spending, meaning that we do not maximize and get the most spending today and save nothing for future, or we become penny pinchers and minimize our spending and make our lives miserable while saving a whole lot of money for our retirement. So, while we are spending, we also have to be considerate of saving. Now, again, I actually put down the same note here with respect to optimization and not maximization or minimization. But saving refers to saving for your retirement, saving for emergency funds, saving for certain purposes. For instance, you want to save for next year's college, perhaps buying a car, perhaps buying a house, perhaps getting married, for a vacation. But we basically, while we're earning just as well as we spend, we also have to save. Now, there are certain risks that we actually are exposed to in any given day. And for that, we actually set aside, or we need to set aside some sort of an emergency fund. Now, this depends obviously on your age and your responsibilities and how many people depend on you and if you're all by yourself. But emergency funding should include things such as medical emergencies. If a family member gets sick and you need to get there, or you need to help them out financially, or just being there with them. This also could be certain disabilities that could take a long time, or your simple things as being in a car accident or having somebody break into your place and stealing your computer or your valuables and so on and so forth. So things happen, and for that we need to set aside some sort of an emergency fund. In later chapters, we're also going to talk about insurance, but for instance, you might want to consider things such as renter's insurance, homeowner's insurance, and certain emergency insurance such as health insurance and medical insurance and so on and so forth. But even so, even if you have insurance, emergency funding, you should have some money on the side just for the rainy day. Now, your financial planning needs to be for a short term and as well as long term. For the short term, obviously, your planning should include things such as your perhaps graduate school, buying or renting a house, buying a new car, going for graduate school, for a vacation, and you want to buy a new computer. You have certain things that you need to spend money on, and you have certain expectations of an income. And these go into your financial planning for the short term. Short term usually refers to about a year, maybe two. Interim would refer to 3 years to 5 years. And then long term would probably be more than 5 years. Long term usually falls into retirement, investing. You're paying for your kids' college. And things like buying a house in the long run, or getting a bigger house, or a nicer car, and that sort of thing. So financial planning has spending, saving, and some sort of risk that you are always exposed to, and preparing for that or being ready for that, and then having these plans for the short term as well as for the long term. Now, with respect to the long-term saving, one of the major aspects is wealth building. Obviously, in order to build wealth, you need to have your spending to be less than your earnings. You need to earn more money than you spend. So if you actually spend more than you earn, then you start borrowing, and borrowing is not something we want to do to finance our extra spending. So we need to know how much we're earning, and we need to know how much we're spending, and we need to make sure that we spend less than our earnings. So it is usually a good idea to save first from your paycheck, meaning let's say you have a paycheck that's about $2,000, perhaps setting aside $250 as a savings and putting it into a savings account, which we're going to talk in the next chapter. And just assume as if your paycheck was $1,750 instead of the $2,000. So just take that $250 out of your paycheck as an example, and then put that into savings first before you start your spending, before you start paying bills, before you consider any other expenditure from your paycheck. So save first from your paycheck, put it on the side, and then look at the remainder of your paycheck as your real income. Now, credit card, I actually refer to it as a trap. It works like this. A financial institution, a bank, a commercial bank, gives you a credit card. It basically allows you to spend the money that you do not have. Now, sometimes you're going to have companies like JCPenney, Macy's, Best Buy give you credit cards. These are actually store cards that are issued by commercial banks. Most of them you will see at the back of the card, you will have a financial institution's name like Citibank or Bank of America or Chase that issue the credit card. Now, the idea again is for these banks to let you borrow and spend the money that you do not have. The way that it works is very simple. You spend the money that you do not have, and then you have about a month to pay it back. Now, if you pay it back, all is great. But if you do not, and you have to pay in installments in multiple months, then you start paying interest, and that interest is outrageous. You're talking about, on average, about 20% a year on credit card, unpaid, meaning not paid within that first month balance. It can be as high as 25, 26, up to 30%, and some institutions charge even more. It can be lower too, but not much lower. So it allows you to spend the money that you do not have, and if you pay it within the first allowed period of time, about a month, then you don't pay interest, and it's actually quite convenient. In fact, most credit cards will give you rebates, 1% cash back, 2% cash back, and most credit cards will give you some sort of insurance on the products that you purchase. For instance, if you rent a car, and if you rent it with a credit card, most credit cards will offer you some level of insurance that you should check with your credit card, but that makes the cost of renting a car significantly cheaper. Some credit cards will charge you an annual fee. Some of them will not. But again, using the credit card, you basically spend the money you do not have, although credit cards may have some benefits as to cashbacks or rebates. You can earn miles for flights. You could get insurance for the products that you purchase through the credit card, and so on and so forth. So the idea from a consumer point of view, from your point of view, is if you use a credit card and you pay it within the allowed time, usually about a month, and you don't pay interest, then financial institutions, the banks who issue the credit card, don't like you. You are not their target customer. They simply don't like you. They don't want you to use that credit card, simply. So the way that it usually works is that these banks will get commissions on the stores or institutions where you use your credit card. The banks who issue the credit cards will charge them a commission. So you're still a customer, but you're not their favorite customer. The favorite customer for a bank is the one that pays interest, that outrageous level of interest. Now, if you actually go into the trap of the credit card, that simply means that you owe a lot of money and you cannot pay, and you have to pay it in installments. Then some people will borrow more just to pay the other one. Some people will get a second credit card just to be able to survive on other things. Some people will get the third one, the fourth one, the fifth one, and so on and so forth. So it will become overburdened, and it will be one of the most financial troubles that undergraduate students or new graduates will face, because you will be cash short. You are, and you probably are, and well, most people are, and at the beginning of your career, you will have these issues with having liquidity issues, which we're going to talk in a minute, and credit card will look a very nice way to spend money, and most people will go into that trap and will end up paying thousands and thousands of dollars just on the interest rates. So with respect to wealth building, obviously retirement saving is really important, and you should consider investing for retirement as soon as possible, because your savings will accumulate and they will have compounding effect, meaning you put aside say $1,000 this year, that $1,000 will earn interest for the remainder of your life until you retire. So if you are, say, 20 years old and you are expecting to retire at 65, you have 45 years of working life until you retire. And the $1,000 that you put today will earn interest for the next 45 years. See, the $1,000 that you put next year will earn interest for the next 44 years. $1,000 that you put in 10 years' time will earn interest for the following 35 years, and so on and so forth. So it is really important that you start saving for retirement as soon as possible. And most institutions will offer you a retirement benefits as part of your job. And this is really important because a lot of the times it may not be as easy to set aside savings from your paycheck. It may be that your paycheck will just be just enough and won't have that luxury of saving. Well, a saving for retirement through your work will be something that's other than your paycheck and will be out of your control, and therefore you'll be able to accumulate wealth through retirement savings through your work. I also wanted to talk about investing, and this is something that I wanted to give you an example. Investing does not have to be investing in stocks, investing in bonds. It doesn't have to be huge amounts. Sometimes it's just a simple few $100s could actually start earning you money. Now, we will talk about different financial institutions, but a brokerage house, a brokerage company does usually handle the investment side of your wealth building. So we'll talk about, what's a bank, what's a brokerage house, and so on and so forth, um, in the later chapter this week. However, an example of a bank would be like Bank of America, Chase, Mattery Bank, or a credit union, and so on and so forth. And a brokerage house could be, examples could be like TD Ameritrade, um, Fidelity, and E-Trade, and so on and so forth. So, but I wanted to give you an example because everybody thinks that investing requires such large amounts of money that you need to start investing when you have your first $100,000 or so. So let's pull up Yahoo Finance, and I wanted to show you a very simple um, ETF. And again, we'll talk about what this is, but it has a ticker symbol called ELD. Just an example. I'm not endorsing this in any way. Just an example that I wanted to show you. It works like a mutual fund, as if you are participating in somebody else's portfolio. And this actually has a emerging market bonds. And again, this is something that we'll talk in later chapters, but simply, think of it like you buy a share of this. If you buy a share of this, $35.75 is all it takes to start investing in this specific fund. And again, just an example. And if you look at this, if you look at the historical data, this actually paid a 14 and a half cents of a dividend every month, approximately. So while this may change, go up or go down a little bit. So with $35, of an investment, with this specific one, you could earn a dividend of 14 and a half cents a month for the rest of your life. So if you were to put aside then $357, just 10 shares of this, then you're going to earn $1.45 every month for the rest of your life. So investing does not have to be with huge amounts. You can actually start investing with small amounts, as little as and the example that I showed you was $35 a share, but there are other ETFs that are available that gives you a monthly dividend or monthly income for as little as $15 or $20 a share. Obviously, if you were to buy something like that, your monthly income would be a little lower perhaps, but the point I'm trying to make is that investing starts with the first dollar. So your first step should be to have a brokerage account. And most brokerage companies nowadays does not even require you to put substantial amount of money into these accounts. A few $100s will get you your first brokerage account. And through that account, you can start investing in individual, again, later chapters we'll talk about specifics of this, but ETFs, mutual funds, stocks, bonds, and so on and so forth. So the other wealth building avenue that everybody talks about is buying a house. Now in the US, buying a house and renting are two huge discussions. Some people love renting and some people love owning a house. I bought my house, and but I see renting just as viable, and there are pros and cons to each. Now, with respect to wealth building, because once you commit to it, this is something that you have to pay every month with respect to mortgage. It just becomes a method of almost compulsory savings for future. And this is very much like, you buy a house, now you have a mortgage, now you got to pay it, and it comes off your, first from your paycheck. So, and you can't back out from this. So you're basically required into saving for future. However, you got to pay mortgage, and a lot of the times mortgage means interest, meaning anytime you buy a house, you pay interest on whatever you owe on the house. So if you actually buy a house for $200,000, you pay interest on the $200,000. If you were to pay it down to say, $180,000, so you pay $20,000 of it, you pay interest on the outstanding balance. You have to pay property taxes, and depending on the county that you live in, depending on the parish or the state, this could be anywhere from 1% to 2.5% to even higher. In some counties in California, I know that the property taxes can be as high as 2.5%. I know in Texas, for instance, I once considered moving there, and the property taxes were about 2%. Now, in Louisiana, we pay about a percentage point. So think of it like this: if you have a $100,000 home, you will pay approximately $1,000 a year on property taxes. So you own this, you got to pay it. You have to pay insurance. You have to pay homeowners insurance. This protects your, if anything happens to your home, such as hurricane, a tornado, or, it also protects you against liability. Somebody drops dead in your house and you get sued, and your insurance will help you pay for the damages. And other insurance issues such as flood insurance, fire hazard, and other types of insurance that you would end up paying for if you own a home. So just as an example, for instance, because we live in a flood zone, we live in a hurricane zone in Louisiana, it's very common to pay a few $1,000s a year on homeowners insurance. You also have to pay for maintenance. Now, you own a home, it's yours. So if something goes wrong, there's nobody that you could call, and or there are people you could call, but they will charge you. So it is up to you to keep the maintenance. You have to, anything goes wrong, your fridge breaks, you have to fix it, or you have to find somebody to fix it, and you have to pay them. So, your roof leaks, you got to fix it. There's some sort of, like for instance, today I've noticed some of my windows downstairs has condensation in between the panes. It's about $200 a window, but I have about 3 or 4 of them. Now I have to pay $800 to get those windows changed. My insurance wouldn't cover this. It is considered routine maintenance, and I have to pay for it. So if I was renting, then I would just call the landlord and say, fix it. And depending on where I live and depending on my landlord, they hopefully would. Now, having said all of this, whatever you pay towards your home to own it as part of your mortgage payment goes to your equity, and you actually build that equity into your retirement wealth building. Now, your mortgage payment, the monthly mortgage payment, will usually include the interest So your monthly mortgage payment will include your interest on the amount of money that you owe. It will include your payment towards the borrowed funds, equity. It will include property taxes, and it will include insurance. Most lenders of mortgage will require you to have insurance, and they are going to open what's called an escrow account, which you put a little bit of your insurance and property taxes every month, and then it basically accumulates into an annual payment at the end of the year, where you actually pay property taxes and insurance through that escrow account. But your monthly mortgage payment will include the interest on the mortgage, your equity portion of the mortgage, monthly part of the property taxes, and the insurance monthly into an escrow account. If you were to rent, on the other hand, well, you're not building equity, but you don't have to worry about property taxes. You could get yourself a renter's insurance, which is significantly cheaper compared to a homeowner's or a flood insurance. And you don't have to worry about maintenance. You could simply move or get the super to fix things for you. But the downside of renting is obviously you don't build any sort of equity, because you're simply renting. So think of it like if you were to own a home, or own a car, or rent a car. So if you were to own a car, after a few years, you're done paying and it's your car. That's it. But you have to pay taxes on it. You have to pay insurance on it. You have to pay maintenance for it. If you rent it, well, rent is expensive. And you may actually drive a nicer car every year, and you may have to, you probably will get a new one every few years. However, whatever you pay, you keep paying it. You never own the car. And you pay insurance. In the example of the car, the insurance that you pay will be the same, whether you own the car or rent the car, and perhaps a little bit higher when you rent the car. With respect to buying a house or renting it, when you buy the house, you have homeowners insurance, you have flood insurance, hazard insurance, and so on and so forth, umbrella insurance. Whereas when you rent it, you have renter's insurance, which usually is significantly cheaper compared to the other ones that you have when you own a house. So our next topic is about financial statements. We'll talk about, pretty much 3 financial statements that are relatively important. The balance sheet, the cash flow statement, and not really a financial statement, but an important aspect of it is the budget. So a balance sheet is basically a document that you should have, and every financial institution or every company has, that lists your assets, what you own, and then your liabilities, what you owe, and then the difference between the two are what is your net worth. So your assets can be cash and cash-like items. So for instance, actual cash, a checking account, a savings account, and then your investment assets and your tangible assets. You own a home, you own a car, you own a computer. However, tangible assets are not liquid per se, and we'll talk about liquid in a minute. But what we mean by cash and cash-like items is something that you could use to pay for your expenses immediately. And your investments more long run, more long term, and therefore you don't necessarily have access to them as easy as cash. Now, obviously, your liabilities, short-term liabilities, an example would be like a credit card that you have to have a payment. You have to make a payment immediately, perhaps the minimum payment that you have to make every month. And then the long-term liabilities like mortgage, student loans. You buy a car, they give you a 5-year financing. They will be more of a long-term liabilities. And the net worth would be the difference between your assets and liabilities. Perhaps when you're considering your assets, you may want to consider cash-like items and investment assets, because your tangible assets, you may not have the actual true value. What if you were to sell them today? So I have a car. I really like the car. I think that it's a really valuable car. But if I wanted to sell it, not everybody may agree with me, and they may not pay what I want them to pay. They may pay very little. So when we're calculating our net worth, we'll look at the assets that we could convert to cash, or investments that we know the true value, and then our liabilities, which does not change. We know our liabilities, how much we owe. The second financial statement is our cash flow statement. On a cash flow statement, we have our income, we have our expenses, and then we have our what's called surplus or a deficit. Now, surplus is good, deficit is bad. And income can be several different things. It could be, wages, salaries, tips, and expenses could be fixed or variable expenses. Now, fixed expenses are things like your rent, insurance payments, and so on and so forth. These are expenses that mortgage payments and so on and so forth, that you do not have much control over it. No matter what happens, you're going to pay these expenses. Variable expenses, however, depends on how much usage you have. So power bill, cable TV bill, I guess, your cell phone minutes, if you're paying them on a variable basis, how much leisure expenses you have, your entertainment, how much gas you spend on your car based on usage, and so on and so forth. So a surplus is when you have your income to be greater than your expenses. And this is good because that means you're actually earning more money than you're spending, and that's good. That allows you to save, that allows you to invest, and that allows you to um, accumulate wealth. The deficit is when you have your expenses that are greater than income. And this is, again, this is common, not ideal. We don't want this, but sometimes we can't control it. You have more expenses than your income, then what do? Well, then you borrow. Family usually comes to mind, and then student loans, and then credit cards, consumer loans. But obviously, this is not sustainable. It is ideal that you need to have income at least equal to your expenses, so you either lower your expenses or increase your income. However, if you cannot help it and you have more expenses than income, and likelihood is most people through college are in this situation, then you accumulate debt. That's how I was when I was in college. I had so much expenses, such as tuition. I had to live, I had to eat, but I had very little time. And I was working a few jobs, but still I couldn't make ends meet, and I started borrowing. It took me a good 4 to 5 years after college to pay off my debt. And, but, you know, the deficit situation is not long-term sustainable. So a budget, well, budget is basically you preparing a cash flow statement before it actually happens, meaning you are planning for future income and future expenses. This is what you think you're going to earn, and this is what you think you're going to spend. It's really important that we have a budget. Now, governments have budgets, corporations have budgets, institutions have budgets, everybody has budgets, because it's really important that you know how much of a budget you have, how much expenses you're going to have, how much income you're going to have, and you need to prepare for that. Sometimes, if you're going to be in a deficit, you may need to borrow. Well, borrowing takes time. It's not as easy to borrow at a short notice as it is if you have a long or if you have time. So based on our short-term, intermediate, and long-term goals, we need to have a budget. With that budget, we can save more, or we are perhaps possible that we could be spending more. So if we know that we have a certain amount of income and we plan for this, and we don't have as much expenses, and therefore, you know, we could end up spending more. So a budget can have a surplus or a deficit, very much like a cash flow statement. But if you have a surplus, that's good. If you're a deficit, you plan for it, and if possible, you try to fix it. You try not to have a deficit. There are certain financial ratios that your book emphasizes, and one of them is the liquidity ratio. This is very simply your assets, monetary assets, because see, the tangible assets, like a car, we don't know the true value of it. You know, we have an idea, but we don't know the true value. So the best way to calculate a liquidity ratio is to get the monetary assets that we know the value for certain and divide it by the monthly expenses. Now, liquidity refers to how fast and how costless can you convert an asset into cash. So again, you know, I have a car. It's a Volvo XC60 2011. It's a very nice car. I love the car. And to me, you know, it's a $50,000 car. And I wanted to, you know, I looked it up the other day, and it says something around like $14,000, if so. So here's my 50. To me, again, I love the car. It's a beautiful car. It's a $50,000 car. Well, there's the reality. So the liquidity is how fast and how costless I can convert that car into cash. And not that easy, not that fast. It probably, see, the key term here is costless. If I were to sell that car, I mean, there are a bunch of these dealers all around. They say, we buy cars. So you drive in and say, I want to sell this car. The guy says $2,000. Well, you know the blue book value and then internet value, 15, 16,000. The guy says $2,000. Take it or leave it. Why? Well, it's you need the money. And well, that's fast right then, but it's not costless. It costs you significant sum. So a liquidity of an asset is defined as how fast and how costless can you convert an asset into cash. So that's your liquidity. So what happens if your income stops unexpectedly? You know, we talked about this with respect to your risk. One of the risks that you have is getting fired, your income stopping. You know, whatever income that you have, what if you don't have it? Are you prepared for this? Liquidity is important because if you don't have income, the only thing that you can depend on the short run, in immediate future, is your monetary assets, cash or cash-like items. The second ratio is asset to debt. It simply is how much assets you have and how much liabilities you have, how much debt you have. So if your total assets is a few $1,000s and you have significantly more than your assets, well, you're in trouble. However, liabilities can be significantly long-term. For instance, a mortgage is about 30 years. You could get a car finance of 5 years. So let's say you bought a $200,000 home and your liability is $200,000, all of it, you owe it, but you have 30 years to pay for this. Your assets could be as low as $10,000. Now, it's not as bad as having the same amount of assets, say $10,000, and then having a $200,000 credit card debt, which you have to pay immediately, which you don't get anything in return. You already spent it. So the liability, asset to debt ratio, the duration, how long the liabilities, within what period of time do you need to pay the liabilities, your debt, is an important question here. Your debt to income, how much debt do you have? How much income do you have? Now, usually the rule of thumb is that your mortgage payment, that includes your mortgage, your insurance, your property taxes, is about 1/3 of your monthly income. Well, based on this, you also have to consider that you got to eat. You have to have other expenses like transportation, other insurance, other utilities, and so on and so forth. So how much debt do you have to finance? How much debt do you have to pay every month? And what sort of an income are you using to pay for this? Now, how long would it take you to pay off all your debt? Think of it. And again, I'm not talking about the mortgage that you have to pay 30 years from now. I'm talking about the debt, like credit card, like car financing, perhaps student loans, perhaps. But then again, I'm not talking about the long-term debt, but your credit cards primarily. How long would it take you to pay all them off? Right? So it's not as easy to set aside, a saving budget from your paycheck. It's also not that easy to save aside some money to pay for your outstanding debt. Then you have to talk about how much debt payments that you're making over how much income you have. And, again, if you're talking about credit cards, how much are those minimums on the credit cards you have to pay, and what is their ratio to income? Now, if you have any investments, how much of your total assets are invested? Now, this is a good ratio because it actually shows how much of a prep you have for your future financial well-being. And, if you're investing too much, there's something, investing too much. You also have to be saving for, buying a house, perhaps, although investment can also be considered, well, mortgage or buying a house can also be considered an investment. So how much am I investing? Are you investing too little? Are you investing too much? And are you not optimizing life? And so on and so forth. So the last topic on this chapter is about keeping financial records. It is a good idea to keep bills, receipts, credit card receipts and statements, bank records, tax returns, brokerage statements, and paycheck stubs. For several reasons, especially credit card receipts and statements. There could be errors, and there are errors. I always check my credit card, and I tell you, every month I actually have an erroneous charge on that credit card. It's either some sort of calculation error with the financing cost. There's some sort of credit card payment that I made, but they didn't do, and so on and so forth. So there's always something that, so as long as you can keep your credit card receipts and your statements, you could dispute these your financial institution, and you could always argue them. But unless you have your receipts, you really cannot. Same thing with the bills and receipts. If you pay something, keep a receipt of it. A paid check, some sort of receipt that says that you paid it. Unless you can prove that you paid it, the bill, unless you can prove that you paid it, you have no legal standing to that bill. So same thing with bank records and brokerage statements. Anything and everything that you do with the bank, with your savings or checking accounts, you have to keep a record of it. Same thing with the brokerage statements. Anything that goes wrong, you do not agree. The only way you can dispute these are if you have your records. Tax returns and paycheck stubs, well, these you need to keep legally. You're actually required to keep them for at least for 5 years, 5 to 7 years. Basically, you could be audited by the Internal Revenue Service or your state's tax authority, and they may actually require you to have your tax returns and paycheck stubs and other related documents. And you are legally actually required to keep a copy of these documents. So for this chapter, that's it. And we'll talk about the other chapters in other lectures. Thank you.